Welcome to Session 9. As usual, we're going to start out the session with the review of the most frequently missed questions. This is the quiz from Session 8. We are going to go all the way down to question number 8. You must fly your dependent child to San Francisco for special treatment not available in your home city. What medical expenses can you deduct? Well, the correct answer is A, the cost of the child's hospital and medical bills, the cost of travel, and up to $50 per person per night for lodging. So if you're staying outside of the hospital and your hotel costs you $100 a night, you will be allowed to deduct $50 of that $100. No food is included. Any other person, if food is included in the child's hospital bills, those are fully deductible. We're going to look at the mini problem. We have Daisy May, age 63. She had the following expenses for 2012. She had pre-tax medical insurance premiums. Well, pre-tax medical insurance premiums are not deductible on Schedule A because you've already received a tax benefit from them by paying for them through a plan at work where you get to pay for them before they assess the federal taxes to you. Prescription copays of $200 are acceptable. Reading glasses, $300 acceptable. Dental visits for $250 acceptable. Medical miles, 250 miles times 23 cents is $57.50, but IRS rules say anything 50 cents or above, we round up, so it's $58. Orthopedic shoes are fully deductible for $250. Her state estimated tax payments. She has made all these estimated tax payments within the calendar year 2012. So she is allowed to deduct the amount for all of those. I have a lot of clients that will pay their state estimated tax payments that are normally due January 15th. They will pay them before the end of December just so they can go ahead and claim them on the current year's taxes. So we've got property taxes on a primary home, $2,400. Property taxes on a vacation home, perfectly fine, $1,245. And then personal property tax on a trailer. Now the trailer, as long as it meets the requirement that you can live in the trailer, then that personal property tax is also deductible. Daisy also paid $265 in foreign income tax, and she's decided to claim those taxes on her Schedule A, which she can certainly do. Daisy's adjusted gross income is $56,000. Included in her taxable income was $400 of interest income and $1,400 of dividend income. Okay, so let's take a look at Daisy May's Schedule A. Her medical and dental expenses, we added up. Her medical and dental expenses add up to $1,058. But when we take a look at what her adjusted gross income is and multiply that by the limits for medical and dental expenses, we find that 7.5% of her adjusted gross income is $4,200. Daisy May's medical expenses are not more than that amount, so none of them are deductible. She ends up with 0 on her Schedule A for medical and dental expenses. Now, this is not uncommon unless you have a retired person that has a number of medical expenses but not much income. Take a look at the taxes paid. We enter $1,900 for her income taxes. We enter $3,645 on line 6 for her real estate taxes. The personal property taxes that she paid on the trailer, $461. And then on line 8, other taxes, we list the foreign income tax. And that's $265. We add up lines 5 through 8 and put the total here on line 9, which is $6,271. She does not have anything else for itemized deductions, so we add up lines 4 through 28, and on line 29 we enter the $6,271. Now that's still going to be more than what Daisy May's standard deduction would have been. So she would definitely go with itemizing her deductions rather than using the standard deduction. And that is the end. Review of the most frequently missed questions. And it's now time to start the lecture portion of session 9.
Well, good morning, everyone, and welcome to Pacific Northwest Tax School's presentation of our course called Itemized Deductions. In today's class, we're going to be covering interest deductions as well as charitable deductions. And accompanying today's class, we do recommend you reference or read various IRS publications, including the pages you see here from Publication 17 and IRS Publication 936, the Home Mortgage Interest Deductions, which is where I have what we call our introduction. And on this page, I've highlighted the portion of Schedule A that we are covering in today's class. You can see I've highlighted interest that you paid and gifts to charity. So those are the areas we are covering. So just as a brief introduction, you use Schedule A to figure your itemized deductions, and in most cases, your federal income tax will be less if you take the larger of your itemized deductions or your standard deduction. And if you itemize, you can take part of your medical and dental. You can also take unreimbursed employee business expenses, amounts that you paid for certain taxes, certain deductible interests, contributions to charity, and various other miscellaneous expenses. You can also deduct, if you have a casualty loss or a theft that's large enough, you can claim a deduction for those events and the loss of value in your property. Now, there are certain people who choose to itemize deductions because there's a tax benefit for it. But there are other people who have to itemize deductions. In other words, they don't really have a choice. They have to itemize. And you must itemize your deductions if either of the following are true. You are married filing separate and your spouse itemizes deductions on his or her return, or you are a non-resident alien filing Form 1040-NR. However, there is an exception for residents of India because of the specific tax treaty that the United States has with India. Indian residents are able to file 1040-NR and claim a standard deduction. But if you are a resident of any other country in the world and you are filing Form 1040-NR with the U.S., then you are not allowed a standard deduction and you must itemize your deductions. I don't have 1040-NR in front of me, but if you were to ever stop and look at it, you would observe that the Schedule A is actually built into 1040-NR, providing people the opportunity to complete that schedule without having to attach a separate page. Now, who should itemize deductions? Well, you should itemize deductions if your total itemized deductions are more than your standard deduction or you are paying the alternative minimum tax. And the reason it says you are paying the alternative minimum tax is that the alternative minimum tax actually does not allow the standard deduction. So if you don't itemize your deductions and you are required to pay alternative minimum tax, the alternative minimum tax will not allow the standard deduction that you entered on your return. And therefore, even if your itemized deductions are smaller than the standard deduction, you may still be better off using them over the standard deduction if you are required to pay the alternative minimum tax. So what are itemized deductions? Well, itemized deductions are deductions that you claim instead of your standard deduction. And you can either itemize or you can claim the standard deduction, but not both. That's different from, say, credits and adjustments to income, where if you claim an adjustment to income on the front page of your 1040, you can still claim a standard deduction. Or if you claim certain tax credits, you can still claim the standard deduction. But with regards to the standard deduction or itemized deductions, it's one or the other and never both. Itemized deductions are, of course, reported on Schedule A of the Form 1040, but you cannot itemize deductions if you are filing 1040-EZ or 1040-A. And if your itemized deductions are greater than your standard deduction, it is usually more beneficial for you to itemize. Now, there's an important rule to remember for all itemized deductions, and it's actually the case for all areas of tax law. In general, the rule is no double deducting. You must use after-tax dollars to pay the expense that you wish to claim as a deduction, and in addition, you may not claim a tax benefit for the same expense in more than one way. If you can claim an itemized deduction for an item that is also used to claim another tax benefit, you may not claim a double benefit. So in that way, you would need to actually choose. So for example, let's suppose you are taking some college courses. You're enrolled in a degree program at university. Well, if you are, you're probably going to be eligible for the tuition and fees deduction, the American Opportunity Credit, or the Lifetime Learning Credit. Any of those three are a possibility. But it's also possible that if you meet the specific requirements that allow for education to be deducted on Schedule A, that you could claim it there, but you wouldn't be able to do it in more than one way. There's 4 potential ways to claim education expense, but you can only use one of those methods for most of the different types of education expenses that you would ever try to claim. And that same rule flows through to other types of deductions, including medical benefits. And here's some examples of ways in which a tax benefit can affect you in more than one way. If you have employer-paid or pre-tax health insurance premiums through your job, obviously you cannot then turn around and claim those as a deduction on Schedule A because that gives you a double benefit. Flex spending accounts that you set up through your employer allow for a salary reduction into a flex spending account, and then you take the money from that account to pay medical expenses. Clearly, you cannot take a medical deduction on Schedule A for expenses that were paid with funds that you put into your flex spend account. Health savings accounts, the same thing. You're allowed to salary reduce into an HSA. You're allowed to make contributions to an HSA that are then deductible. Once the money is in the HSA and you pull it out, if you spend it on medical expenses, it's not taxable to you, but it's also not deductible to you. Next topic in line is interest. So we're moving right along, moving on down that Schedule A page. And we're now looking at lines 10 through 15. This is where we are able to enter interest deduction. In general, the IRS doesn't allow you to deduct interest. There's 2 exceptions. There's 2 allowable forms of interest that can be deducted, and that's what we're going to talk about here. You are allowed to claim a deduction for interest you pay on your first or second home mortgage, and you are also allowed to claim a deduction for investment interest to the extent that it does not exceed your investment income. If you have deductible interest, you claim it on lines 10 through 15 of Schedule A. And of course, the mother of all deductions, the grandma of all deductions, my favorite deduction of all is the home mortgage interest deduction. The reason I like the home mortgage interest deduction is that it's a deduction that even the alternative minimum tax leaves alone. And I have a lot of clients who are subjected to alternative minimum tax, and very often they're at high enough income levels that they're paying off their home mortgage really rather quickly. And I'm always looking at them as they're asking me, how come I'm paying so much alternative minimum tax this year? And the answer is because you paid off your home mortgage, or because your home mortgage is very small. It's your only defense against the AMT. We kind of look in, think of the Harry Potter movies. There's the defense against the dark arts class, right? That Harry Potter goes to, the defense against the dark arts. Well, if you kind of look at that, equivalent would be the alternative minimum tax. It's that dark tax out there that seems to impose itself and bear down on you in every way imaginable. And the only defense against it, I say, the full, true defense against it, is your home mortgage interest. Interestingly, politicians right now in Congress, and also fellow tax professionals and the IRS, are talking about what's going to be done to shrink the deficit. What are we going to do to, increase the tax pool? And one way to do that is, of course, to increase income tax rates, but lots of people think that's a bad idea, that instead we should do away with certain tax deductions. And one of the ones they keep bringing up is the home mortgage interest deduction. And that's certainly not my choice because, as I said, if you're subjected to alternative minimum tax, this is your only defense against it. And if the home mortgage interest deduction is phased out or taken away, that middle income group of taxpayers, people who are hit by alternative minimum tax, which is typically people earning between $150,000 and $500,000, that group of people, they're going to lose one of the major deductions that assists them. But let's move on with a discussion of just home mortgage interest in general, and under current law, who is allowed to claim it. Interest you pay on a loan that is secured by your main home or second home is called home mortgage interest. And you must meet these tests to be able to claim a deduction for the mortgage interest that you paid. You must be legally liable for the loan, and there must be a true debtor-creditor relationship between you and the lender. The mortgage must be secured debt with your home offered as collateral for the loan. So what is secured debt? Well, you can deduct your home mortgage interest only if your mortgage is a secured debt. A secured debt is one in which you sign an instrument, such as a mortgage, deed of trust, or land contract, that makes your ownership in a qualified home security for payment of that debt, and provides in case of default that your home could satisfy the debt and is recorded or is otherwise perfected under any state or local law that applies. In summary, your home mortgage is a secured debt if your home is used as collateral to protect the assets of the lender, and if you cannot pay the debt, Your home can then serve as payment to the lender to satisfy or pay that debt. Debt that is not secured by a home. A debt is not secured by your home if it is secured solely because of a lien on your general assets, or if it is a security interest that attaches to the property without your consent, such as a mechanic's lien or a judgment lien. So let's just suppose you have a big debt with someone who came and did some repair work on your home, and you didn't pay them for whatever reason. So they take you to court, and you lose. And so the court allows them to put a lien on your home. That lien is not a mortgage and would not be treated as a mortgage for purposes of any interest you might ultimately pay to that lien holder. Also, debt that is not secured debt is something called a wraparound mortgage. And this comes up all the time. I have clients ask me, can they claim a deduction in a situation like this? All the time. Let's see what we're talking about. A wraparound mortgage is a form of seller financing where the seller remains liable for the original loan. Payments are made by the buyer to the seller, who in turn makes payments to the mortgage holder. A wraparound mortgage is not a secured debt unless it is recorded or otherwise perfected under state law. So another way you might look at this is an assumed loan. Let's just suppose you've got a house and you want to sell it. And along comes a potential buyer, but their credit's not very good, or maybe they're recently unemployed. They look like they'd be a good buyer, but they're not going to be able to qualify for a conventional loan. So you say, that's all right, I'll keep the mortgage under my name, I'll continue to make the payments, you just pay me, and you can buy this house. And that'll be the deal. Well, the IRS says, no, that's not going to be allowed because that's not been perfected under state law. Now, if you did go to a title company and get the thing registered through the county and the state, then it could be considered perfected, even if it's done in that fashion. But most of the time, it doesn't work that way, that far in. Another way that I sometimes see it is you might have two brothers. One brother has good income and credit, the other has little income, little credit, or both. and so the one brother says, you know what, why don't we buy this house and I'll sign off on the mortgage and you can be the owner of the house. We'll both be titled on the house, but the loan will only be in my name. And then you just make the payments on the mortgage. Well, that one's fishing for it. You're going to have to really see that there is some kind of a debtor-credit relationship there, and I'd want to make sure that there is a legal document between those two brothers that shows that the one is lending money to the other and that there's some ramification that the brother who has signed on that loan could seize the house if the other brother doesn't make payments on it. There has to be some kind of perfected legal document, and I can't really describe to you what that legal document would look like. You would need to talk to title companies in your area or attorneys in your area to make sure that your client is sufficient in that department. But here we have an example that the IRS actually publishes in IRS Publication 936 on page 4, an example of a wraparound mortgage that does not meet the criteria. Betty owns a home subject to a mortgage of $40,000, and she sells the home for $100,000 to John, who takes it subject to the $40,000 mortgage. Beth continues to make payments on that $40,000 note, and John pays $10,000 down and gives Beth a $90,000 note secured by a wraparound mortgage on the home. Beth does not record or otherwise perfect the $90,000 mortgage under the state law that applies. Because the mortgage was not perfected under applicable state law, it is not a secured debt, and John cannot deduct any of the interest he pays on it as a home mortgage interest. So if your clients are coming to you with situations that sound like that, then whether or not it's going to be deductible to them is going to depend on whether they've perfected that mortgage under state law, and that would probably mean talking to title companies or getting professional opinions, which we as tax consultants, tax advisors probably aren't competent in. Choice to treat the debt as not secured by your home. So let's just suppose you do have a debt that's secured by your home, and you are allowed to therefore deduct it on Schedule A. You can choose not to treat that debt as secured by your home and deduct it somewhere else instead if it makes sense to do that. This treatment begins with the tax year for which you make the choice and continues for all later years. And you can only revoke that choice with the consent of the IRS. You may want to treat a debt as not secured by your home if the interest on that debt is fully deductible, for example, as a business expense, whether or not it qualifies as home mortgage interest. So let's just suppose you have a home and you take out a home equity loan on your home to purchase a rental property. Well, that money that you've borrowed on your home is actually being dedicated to a business purpose, the purchase of that rental property. You can choose to deduct it as home mortgage interest on your Schedule A, or you could choose to put it on the rental property. But if you choose to put it on the rental property, then it has to stay with that rental property. You can't later on move it back to the Schedule A. So what portion of my mortgage interest is deductible? Your mortgage is fully deductible to the extent it fits into one of the following categories. The first is grandfather debt, and I have a hard time imagining there's too much of that around anymore, because grandfather debt is a mortgage that you took out before October 13, 1987. Since most mortgages are 30-year mortgages, that 30-year mark passed a long time ago, but perhaps someone had a 50-year mortgage, I don't know. The next one is home acquisition debt. Mortgages you took out after October 13, 1987 to buy, build, or improve your main home, plus any grandfather debt that totals $1 million or less. Take that number and divide it in half if your filing status is married filing separate. And finally, home equity debt. Mortgages you took out after October 13, 1987, other than to buy, build, or improve your home, but only to the extent that the total of these loans was $100,000 or less and totaled no more than the fair market value of your home, reduced by 1 and 2, or $50,000 if your filing status is married filing separately. So what this is saying is when you purchase a home, the cost of buying that home, any mortgage you take out at the time you purchase it, is called home acquisition debt. Home acquisition debt is fully deductible as long as it's $1 million or less. Now, it could be the case that at the time you purchased your home, you took out a first mortgage and a second mortgage, but they were both taken out at the time you acquired the home. Those would both be treated as home acquisition debt. Now, it's also possible that a few years later, after you bought that home, you decide to refinance. And the IRS says home acquisition debt includes any debt used to refinance a loan, but only up to the amount of debt existing at the time of the refinance. So if you purchase a home for $500,000, you have a $400,000 mortgage, and 10 years later you refinance when your mortgage is down to about $350,000 or $300,000, let's just say around number $300,000. And at the time you refinance, the house is now worth $700,000, so you borrow $500,000. Well, you're in a situation where the original home acquisition debt was $400,000. At the time you did the refinance, you only owed $300,000, and now you've borrowed $700,000. Well, you're going to have $400,000 of acquisition debt that would be deductible, and the first $100,000 of the $300,000 of equity that you took out would be deductible, but nothing above and beyond that. So that's an important rule to look at, and it's probably not one that occurs to most of us when we're preparing a client's tax return to ask, is this the original mortgage, and if not, did you take out more than the original debt that existed on it? Those are kind of complex questions that probably would never even occur to you to discuss with your client during preparation of their return. So perhaps at the time, if you're preparing a client's tax return, it should be a habit that you have each and every time you work with a client to be asking them if they refinance their home during the year, and if so, could you look at the closing papers? Could you determine in that what the payoff was on the existing mortgage and how much equity debt they took out, if any? Now, there's an exception to that rule, and that exception is if they took out home equity to make improvements to the home, then any home improvements made would be considered acquisition debt and not equity debt. So let's talk about some special situations next. The following charges are deductible as home mortgage interest. They include late payment charges on mortgage payments, mortgage prepayment penalty, prepaid interest. However, you must spread this interest as a prorated amount over the life of the loan. Ministers and military housing allowance. Even if you are exempt from tax on your housing allowance, you can still claim mortgage interest you paid as an itemized deduction. Divorced or separated individuals. If your divorce agreement requires you to pay the mortgage on a home jointly owned by you and your spouse, but you did not live in the home, 1/2 of the mortgage payment may be considered to be alimony. You may deduct half the mortgage interest paid as an itemized deduction. So mortgage interest payments that are not deductible. There are certain types of mortgage interest payments that are not deductible. Mortgage proceeds invested in tax-exempt securities. This is kind of a downer. You cannot deduct the home mortgage interest on a grandfathered debt or home equity debt if you use the proceeds from the mortgage to buy securities or certificates that produce tax-free income. I kind of wonder why that matters, what you spend the money on. You can spend it on anything except tax-free securities, apparently. And reverse mortgages, they're one that you need to watch out for because they're increasingly common, heavily promoted, and they do target retired people who are short on cash as a means of helping them live more comfortably in their final years. But typically, once one of your clients changes from a home mortgage to a reverse mortgage, they're not going to have a deduction anymore. A reverse mortgage is a loan where the lender pays you in a lump sum, a monthly advance, a line of credit, or a combination of all three of those, while you continue to live in and retain ownership of your home. The following facts apply to reverse mortgages. The money you receive from the lender is a loan and therefore is not considered to be income to you. So if you take out a reverse mortgage and you're getting a monthly payment from the mortgage company, you don't have to pay tax on it because it's not income. Interest accrues on the money that the lender gives you. However, it is not deductible until you actually pay it. And typically under reverse mortgage, the lender is giving you a monthly check, but you're not paying any money to the lender. And because you're not paying any money to the lender, it's not possible for you to have paid any mortgage interest, is it? A reverse mortgage typically becomes due with interest when you move, sell your home, reach the end of a pre-selected loan period, or you die. Any interest, including original issue discount accrued on a reverse mortgage, is deductible when you actually pay it, which is usually when the loan is paid off in full. And a reverse mortgage, to boot, is generally a form of home equity debt, which means that your deduction may be limited if the amount of debt exceeds $100,000. So reverse mortgages create a situation there can be all kinds of obstacles to the deduction. And the final obstacle is that if the debt is over $100,000, you have to make sure it is not home equity debt. And to the extent that it is home equity debt, it wouldn't be deductible at all. Refunds of interest. The following rules apply to refunds of home mortgage interest that you received during the year. If you receive a refund of interest in the same year that you pay it, you must reduce your interest expense by the amount refunded to you. If you receive a refund of interest you deducted in an earlier year, you generally must include that refund in income in the year you receive it, to the extent you received a tax benefit from deducting it in the earlier year. If you received a tax benefit from interest deducted in the earlier year and that interest is refunded to you, then it becomes taxable regardless of whether it is refunded to you as a cash payment or it is used to reduce the outstanding principal on your mortgage. Now, if you need to include a refund of interest in income, you report it on Form 1040, line 21. If you receive a refund of interest you overpaid in an earlier year, you will generally receive a Form 1098 showing a refund amount in Box 3. Prepaid interest. If you pay interest in advance for a period that goes beyond the end of the tax year, you must spread this interest out over the tax year to which it applies. You can deduct in each year only the interest that qualifies as home mortgage interest for that year. However, there is an exception for points, and we'll talk about those. Divorced or separated individuals. If a divorce or separation agreement requires you or your spouse or former spouse to pay home mortgage interest on a home owned by both of you, the payment of interest may be alimony. And here is an example where the mortgage payment is alimony. Pursuant to her divorce decree, Reba made mortgage payments on a home jointly owned by herself and her ex-spouse. During the year, Reba paid $24,000 in payments on the mortgage. The payments were applied as follows: $15,000 to mortgage interest, $5,000 to real estate taxes, $1,000 for hazard insurance on the home, and $3,000 went towards principal payments on the loan. Reba is not able to deduct all of the mortgage interest she paid because she made payments on a property that is 50% owned by her ex-spouse. Instead, she will be allowed to claim the following deductions related to the payments on her home loan. Reba's mortgage interest deduction will be limited to $7,500, which is 50% of the mortgage amount that she paid. She will be able to claim a deduction for 50% of the taxes she paid, which is $2,500. And she will be able to claim a deduction of $12,000 as an adjustment to income for alimony payments on the front page of her tax return. Where does the $12,000 come from? Well, 50% of the $24,000 of payment she made was for the spouse's benefit, or in her case, the ex-spouse's benefit, and therefore it is considered to be alimony. $12,000 is alimony. Now, Reba's ex-spouse, things are the reverse, well, or similar. The spouse will be able to deduct $7,500 of mortgage interest. The spouse will be able to deduct $2,500 of real estate taxes, and the spouse will report $12,000 of income from alimony received. An itemized deduction is not allowed for either the hazard insurance or the principal payments made on the loan. However, to the extent that Reba paid these amounts for her ex-spouse, they are alimony deductions to her and income to her spouse. And here we have the mortgage interest statement coming up next. This should be a fairly familiar document to you. Most of our clients who come in with a mortgage interest statement, it looks something like this. There might be an attachment at the bottom, or it might be longer and flip over with more information, but typically somewhere on the statement there's a form that looks like this. And what we're interested in is the mortgage interest that's received from the payer in line 1, points paid on purchase of the principal residence. And remember box 3, if there's a number in that, that would generally be reportable as income on line 21 of the 1040. And box 4 is essentially up to the lender. They can use that box for what they choose. Most lenders use box 4 to report payment by the borrower of mortgage insurance and real estate taxes. So typically if the lender is going to provide that information, they would use box 4 for that function, although I see plenty of times where the lender doesn't use box 4 at all. Some lenders don't make any statement on the 1098 whatsoever as to how much real estate tax paid out of escrow, and others always put it on if they in fact had an escrow and paid out for taxes. So box 4 may have or may not have the information you're looking for. Another thing to look here is the payer's social security number. This 1098 document is a document that does get filed with IRS by the lender. And if you claim deductions on your tax return, on your client's Schedule A for mortgage interest paid, it had better be the case that the social security number on their tax return is the same as the social security number on the 1098. If you enter mortgage interest deductions on a Schedule A where there is not a corresponding 1098 with their social security number on it, that client is more than likely going to receive a CP 2000 letter from the IRS saying, hey, you claimed a deduction on Schedule A for $10,000 of mortgage interest, and we see no corresponding 1098 to go with that. Well, what do you do in a situation like that? Well, firstly, why is their number not on the 1098? Well, it could be this is a joint loan. Maybe two individuals got together and purchased a home together, and one of those individuals is the one that's claiming mortgage interest, but their other partner's social security number is the number that is on the 1098. And when that happens, you're going to have to account for that to the IRS and explain it. So let's continue on with this topic. Mortgage interest not reported on a 1098. What do you do? Well, that's why the IRS has line 11 on the Schedule A. It says home mortgage interest not reported to you on 1098 if paid to the person from whom you bought the home. See instructions and show that person's name, identifying number, and address. So here we go. If you pay your mortgage interest directly to the seller, you are paying a seller-financed mortgage. Generally, you will not receive a 1098 mortgage interest statement and must provide additional information about the lender on Schedule A. If you are paying your mortgage as a seller-financed mortgage and you do not receive Form 1098, you must do the following. Report the amount of interest you paid to the seller on Schedule A, line 11, and in the space provided to you on line 11 of Schedule A, provide the payee's name, social security number or EIN, and their address. So all of the information is required. And here we have the seller's name, Wilma Deering, her social security number, her address, and then the amount that was paid to her. And the $500 that we have up here, that would be for some other amount that is reported on a 1098. The next topic in line is points. Points are a form of prepaid interest, and generally you must amortize points you pay over the life of the loan. Now you will notice on the Schedule A here, line 10 says home mortgage interest and points reported to you on Form 1098. And then on line 12, it says points not reported on a 1098. So if your client has some points on a 1098 and other points not on a 1098, you would ultimately have points entered on 2 lines of the form. Points are typically amortizable over the life of the loan, but there is an exception to that. Points are fully deductible and can be claimed in the year paid if you meet the following tests. Number 1, your loan is secured by your main home. You must always amortize points you pay on your second home. Paying points is customary for the area in which you live. The points charged were not more than points generally charged in your area. You used the cash method of accounting. Points were not a substitute for other common closing costs such as escrow fees, down payment, title fees, etc. The funds you provided at closing were at least as much as the points charged. You used your loan to buy or build your main home or to improve your main home. The points were computed as a percentage of the principal amount of your mortgage loan, and the amount is clearly shown on the closing or settlement papers. If you meet all of these tests, you can choose to deduct points paid in the year you pay them, or you can amortize them over the life of the loan. For refinancing, the following rules apply to points paid on a refinance of your home mortgage. Generally, you must amortize points you pay to refinance, even if the new mortgage is secured by your main home. If you amortize your points, you can claim a deduction for points as a prorated amount each year, and then, if you pay your mortgage off early, you can choose to claim a deduction for all of the remaining unclaimed points in the year you pay off your loan. Well, this is a little bit of work for the tax practitioner and the taxpayer in general, because most of my clients who own homes refinance at least once before they sell. Well, right now, mortgage rates are so low that anyone who buys a home now may not want to refinance in the future because they're going to want to keep that low rate. But over the last 20 years, mortgage rates have steadily dropped over time. 20 years ago, it cost you 8% to get into a house, and now we're at, what, 3 to 4% to get into a house. But even during the Clinton administration, rates were dropping down to 6%, which was considered to be really low. And so over time, people just do keep refinancing their homes. Sometimes it's to get cash back out that they need for other purposes. Sometimes it's to secure a better rate. For whatever reason, they're refinancing their loan. And at the time they do a refinance, how are you going to know that they paid points? The only way you're going to know that they paid points is if you ask to see the settlement statement, because the settlement statement will show if they paid points. And typically on a refinance, points are not going to show up on the 1098. So you have a settlement statement that shows, hey, points were paid on this refinance. And you go, okay, well, there's $3,000 of points paid on this refinance. And now I need to enter a deduction for that. And if it's a 30-year loan, that would equate out to an average of $100 a year that would be deductible on Schedule A as points not reported on 1098. It would essentially go on line 12 of the Schedule A. So you enter that deduction down. Well, the next year, do you remember to put the deduction in there? And the next year after that, and the next year after that. And after 10 years, maybe your client sells the home where they've still got $2,000 of the $3,000 of points that they haven't claimed. And in that year they sell the home, then you're allowed to claim the balance of points. But all of that demands record keeping or a trail, some kind of method or mechanism for keeping track of that. So in our tax software, what I do is every field where I can enter a number, I can actually double click on that field, blow it open, and then type in a description in there. And so what I do is whenever points are paid, I make that entry on Schedule A on line 12. I double click on the field. It opens up a screen where I can type in the date of the refinance, the amortization period, and the amount of deduction that I'm claiming each year. And therefore, when they do ultimately sell that home or refinance at a future point, I can figure out the balance that was not deducted. But I don't think most preparers are that diligent, and therefore I'm assuming that most customers are losing out on deductions when they refi and sell. Mortgage ending early. If you spread your deduction for points over the life of the mortgage, you can deduct any remaining balance in the year the mortgage ends. A mortgage can end early due to a prepayment, refinance, foreclosure, or similar event. If you refinance the mortgage with the same lender, however, you cannot deduct any remaining points for the year, and instead you deduct them over the term of the new loan. So if you had points with the lender, you refinance with that same lender, the old points will add to the new points, and you amortize over the life of the new loan. Here we have an example where balance of points are deductible in the year the loan is paid off. Dan paid $3,000 in points in 2005 that he had to spread over the 15-year life of his mortgage. He had deducted $1,400 of these points through 2011. Dan prepaid his mortgage in full 2012. He can deduct the remaining $600 of points in 2012. And this comes straight out of the IRS publication. It's not my own example. Points paid by the seller. If you buy your main home and then the seller pays the points for you, you should deduct the points as if you had paid them yourself. Your cost basis in your property is reduced by the amount of points that the seller paid for you. If you are the seller and you pay points for the buyer, you may not claim the points you pay as a deduction. Points you pay increase your basis in the property and reduce your net profit from the sale. And here we are looking at a settlement statement again. This time, instead of looking for the tax prorations, we're looking for points. Because whenever I see settlement statements, there's two numbers I'm looking for. I'm looking for the proration on taxes, and I'm looking for points. And on this piece of paper, you will observe that you will never see the word point. Point is a word used by the IRS in its publications. It's probably used in lots of other areas as well. But when it comes to settlement statements, it's not a term that I see. And I've noticed that mortgage lenders don't like to use the word points. If you call up and say, yeah, are you charging any points? They'll go, oh, no, we're not charging any points. And then we get to the point, they'll say, well, we do have a loan origination fee. It's just another word for point, and it is a point, as long as it's assessed at a percentage rate of the loan amount being borrowed. And here we see our origination charge is 1%, and it's being assessed on the loan, which obviously is a $151,900 loan, and 1 point of that is $1,519. And that is the amount that would be deductible as points paid in the year of purchase. When we go down to this line, we'll see items required by the lender to be paid in advance. And typically when you go to purchase a home, they're doing some figuring in there. I don't know how they come up with the numbers. It's kind of not important to me. What's important to me is that when a buyer closes, they're supposed to bring a certain amount of money to the table. And on this particular purchase, $73.47 had to be brought to the table by the buyer to prepay a little bit of interest for a 3-day period here. Well, that interest amount is going to be included in the 1098. You don't go to the closing papers, pull off the points, and then pull off this and add it to the 1098. This number for sure is likely already in the 1098. Now, this $1,519 may or may not be on the 1098. So when I have a client that did purchase a home, I'm asking them to bring in the settlement statement from the purchase of the home. I'm looking at the 1098 and I'm saying, okay, do the points match the 1098? If they match the 1098, then they're deductible, and I would enter them on line 10 as points paid and mortgage interest paid. But if they're not a match to the 1098, in other words, there's more points paid than appears on the 1098, then I need to establish whether those additional points really are deductible points. And if they are deductible points, then to the extent they're not on a 1098, they would go on line 12 of the Schedule A. And the next topic of the day is mortgage insurance premiums. And we have those being entered on Schedule A, line 13. You may be able to treat mortgage insurance premiums you paid in 2012 as home mortgage interest subject to the following rules. The mortgage insurance must be paid in connection with home acquisition debt. The mortgage insurance contract must have been issued after December 31, 2006, and you must have paid the premiums before 2013 for coverage in effect during 2012. Deduct mortgage insurance premiums on line 13 of Schedule A. Now, there is a limit on the amount of mortgage insurance premium you are allowed to deduct, and it is based on your income. If your income is more than $100,000, you start to phase out. If your income is less than $100,000, you are allowed the mortgage insurance premiums you paid as a deduction in full. And the phase out is over a $10,000 range. So if your income is more than $109,000, your deduction for it is going to phase out. Here's an example of how that phase out is going to work based on how it applies. William A. Rogers, born in 1982, has wage income and AGI of $102,000 for the year. And on 4/1/2012, he purchased a new home in Columbus, Ohio. He paid the following expenses for the year: personal property tax on his car of $600, balance due to Ohio on 2011 return that he filed with Ohio was $400. He had Ohio State withholding showing on his W-2 in the amount of $4,000. He paid property taxes for the home owned by his mother in the amount of $1,200. He paid interest on a line of credit with Bank of America, and he used that line of credit to make home improvements. And finally, he has interest that he paid on a travel trailer loan with the Bank of America in the amount of $800. The EIN and address of Bank of America is 93 with all the zeros you see here, and I've also provided the address. And William's HUD or HUD statement is attached, his settlement statement. Prepare his Schedule A as shown next. Well, let's take a look at his 1098. On the 1098, we can see that he shows mortgage interest in box 1 of $12,000, and he has points paid on purchase of $3,000. Down in box 4, it says PMI 2000. That's his mortgage insurance premiums, and it also shows taxes that went out in the amount of $1,500. Well, the PMI and the taxes are going to be deductible to him, as are the other amounts in boxes 1 and 2. But we're going to have to do a worksheet to figure out how much of the PMI is deductible because he's into the phase-out range on it. And with regards to the taxes, because William purchased a home, I'm interested in whether or not this amount is the only amount he gets to deduct, or in fact, maybe he gets to deduct a lesser amount or a greater amount. So let's look at his settlement statement and figure it out. We can see here on the settlement statement that there's a county tax assessment going on here on the settlement statement. This is an amount of tax that was paid for in advance by the seller, and so the buyer, William, had to bring this money to the table to close on the sale. He had to bring $750 to the table to close on the sale. And so this amount is not an amount that went into escrow. It was not an amount that was paid out by his mortgage company. The amount that was paid out by his mortgage company during the year, $1,500, was amounts that William paid to the mortgage company that the mortgage company then put in escrow. And this $750 is not a part of that. So that tells me that William's can be able to deduct $750 plus $1,500. Moving on to page 2 of the settlement statement, we can see that he paid points, $3,000. Those are an exact match to what is shown in his box 2, has $3,000 in it. So let's move on to William's Schedule A and see how all of these numbers came together. We begin on line 5 by entering the $4,000 that shows on his W-2 as withholding and adding to that the amount that he paid to Ohio with his 2011 return. That was $400, so we enter that, $4,400. We then look at the real estate taxes. $3,000 paid out through escrow plus another $750 he paid at close. That's $2,250. Personal property taxes that he paid during the year, $600. Those are deductible. And of course, the property taxes he paid on his mother's home, he can't claim those. Then we go over to his interest section, and on line 10, we enter the $12,000 of mortgage interest plus the $3,000 of points he paid on purchase. And remember there in the notes I said that he had 2 different amounts that he paid to Bank of America. He paid $800 for a loan he has on a travel trailer. Well, did you know that that travel trailer qualifies as a second home, provided that it has sleeping and eating facilities in it, which most travel trailers do? And if he paid $800 on that loan and that travel trailer is secured by a loan through B of A, it meets the criteria for being a second home, and that the interest on that is deductible. But the interest that he paid on the line of credit that he used to purchase home improvement supplies, that's not deductible. And then we have the mortgage insurance premiums. He paid $2,000, but only $1,600 is deductible. So let's see how we figure that. And it is a $10,000 phase-out range there. So there's a typo earlier on in the manual. So we start with the $2,000 amount that he paid in mortgage insurance premiums, and then we enter his income. From his income, we subtract $100,000. When we do that, we get $2,000. $2,000 is 20% of the way into that phase-out range, which means that ultimately 20% of his mortgage insurance payments are not deductible. 20% of $2,000 is $400. That's the amount he can't deduct, and that leaves him with $1,600 that he can deduct.
Brisbane, B-R-I-S-B-A-N-E, Brisbane.
And investment interest is claimed on Schedule A, line 14. Investment interest is interest that you pay on money that you borrow for investment purposes. If you borrow money to purchase stock or other investment property, you have investment interest. Investment interest is deductible to the extent you have investment income. Let me kind of think of, it's good and topical because it goes hand in hand with mortgage interest. Let's suppose that you are considering buying a beach house, and that beach house comes with land, and it would be your second home. If you were to buy that beach house, then you would have a second home, and the interest that you pay on it would be deductible. Well, let's just say that instead of that, you decide to purchase beachfront property. You think that in the future you might build on it, but maybe not. Maybe it's just a good investment. You think that that beachfront property is going to go up in value, and maybe in 10 years you can sell it and make a good amount of money. But it's secured by debt. You have a loan on it, and you're paying interest on that loan. Well, one of the key things to remember is that a vacant land would not be your second home. It lacks the necessary elements to be a second home, and that is that where are you going to live on vacant land? You have to have something built on the land to be able to live on the land, and therefore interest that you pay on vacant land would not be mortgage interest. It wouldn't be second home mortgage interest either. It would be investment interest. And actually, while we were on break, we had a couple of interest questions that came up. The first one was related to the concept of the reverse mortgage. One of the attendees, Mary Beth, said, I had a client that had a mother with a reverse mortgage. The mother passed away, and he could not sell the home. The reverse mortgage company demanded payment. She had no funds. He paid the mortgage. Is there a deduction for him? Could the home be considered a second home or maybe investment property? Well, the answer is If the client had a mother who had a reverse mortgage and then the mother dies, it depends on when did that reverse mortgage get paid. If the reverse mortgage got paid after she died, then on the day that she died, ownership of that property, that home, transferred to the estate. It was no longer her property. She can't own it because she's dead. So that property becomes property of the estate. Now, sometimes you have a home that is titled where there's joint rights of survivorship, things of that sort. But let's just suppose that none of that's coming into the equation. It's simply that she died, so the house became part of her estate. Well, now the estate owns the house. Is the estate paying the mortgage off? Or does the estate transfer that home to an heir who then in turn pays that mortgage off? So you have to really look at who is the owner of the home and who pays the debt. If mom continues to live and the son comes along and pays that debt for her, mom's not going to be able to deduct that because she didn't make the payment. And son wouldn't be able to deduct it either because he didn't own the property that the debt was on. So you've got to be careful about how all of that situation arranges, but given the right facts and circumstances, I could see that the son would become the owner and be able to claim the deduction. The next one is, does a travel trailer need to have a bathroom to be a second home? And I wasn't quite sure. I couldn't remember, so I went and looked that up. It's in publication 936, which is the IRS's publication on home ownership. It's called the Home Mortgage Interest Deduction. It's publication 936. And on page 4, it defines a second home as including boats, travel trailers, motorhomes, provided they have eating, basically cooking facilities, sleeping facilities, and a toilet. But apparently they don't need to have a shower. Toilet's enough. They spell it out that way. All right, so with that, let's continue on with a qualified investment interest. In terms of, I just explained that a vacant lot could be a piece of investment property on which you took out a loan, although it might not be something that we normally think of. More often when I think of investment interest, I think of margin interest that you have through your brokerage account, that you're borrowing money to purchase stock or purchase investments, and that account is churning all the time with money being borrowed and invested, and then other stock being sold to pay off the loan and so forth. It all happens kind of in the background, and if you're looking at brokerage statements and you're flipping through the pages, if investment interest was paid, it's usually going to show up in there, and it'll be called margin interest. There is a limit on your investment interest deduction. Generally, your deduction for investment interest is limited to the amount of your net investment income. So what's investment income? Income you derive from property you hold for investment is investment income. The income can come from interest, dividends, annuities, and royalties not derived in the ordinary course of a trade or business. Net investment income does not generally include net capital gain income or qualified dividends. However, you can choose to include all or part of this income in investment income by filing Form 4952 and reporting the elected income on line 4G of that form. If you choose to include any amount of your net capital gain income and or qualified dividends in investment income, then that portion that you choose to treat as investment income is not eligible for the lower 15% capital gain rate. Before making either choice, you should figure your tax on capital gains with and without Form 4952 line G income to figure which will give you the lowest overall tax. Non-deductible investment interest expense. Investment interest expense is only deductible to the extent the interest is related to production of investment income. The following kinds of income are not considered to be investment income for purposes of this deduction: tax-exempt income, interest expenses on straddles, Alaska Permanent Funds dividends, passive activity income, income from the active conduct of a trade or business, and royalty income derived from the active conduct of a trade or business, whether or not you're passive or non-passive in that activity. Allocation of interest expense. If you borrow money for business or personal purposes as well as for investment, you must allocate the debt among those purposes. Only the interest expense on the part of the debt used for investment purposes is treated as investment interest. The allocation is not affected by the use of the property that secures the debt. And here is an example where we have an allocation. This comes out of IRS Publications 550. You borrow $10,000 and use $8,000 of it to buy stock. You use the other $2,000 to buy items for your home. Since 80% of the debt is used for and allocated to investment expenses, 80% of the interest on that debt is investment interest, and the other 20% is non-deductible personal interest. So how do you go about deducting your investment interest? Well, you have to complete Form 4952 in certain situations, and in other situations you don't. You report your deductible interest expense on Form 4952 on Schedule A, line 14, and you're required to use the form if you have a carry forward of unused investment interest from an earlier year, or in the current year, your investment interest expense exceeds your investment income. But if your investment income for the year is equal to or greater than your investment expense, the form is not required, and you can simply enter the expense directly on line 14 of Schedule A. You can also claim a deduction for investment interest expense on line 23, subject to the 2% limit on miscellaneous deductions if you don't have an offsetting investment income to claim against. Here are an exceptions. Again, most of the time, Form 4952 is required if you've got a more complex situation with either a carry forward from an earlier year or a carry forward to the next year. But you can deduct all of your investment interest expense, and you do not need to complete Form 4952 if you meet all of the following tests. Your investment interest expense is not more than your investment income from interest and ordinary dividends. You have no other deductible investment expenses, and you have no disallowed investment interest expense from an earlier year, 2011. Here is an illustration of how you would complete Form 4952, assuming it's required, and in our illustration it is. The character in our story is named Austin Powers, and he has the following investment and capital gain income for 2012. He has a 1099 INT showing Box 1 ordinary interest of $100. He also has a 1099 DIV showing Box 1 ordinary dividends of $300. On that same 1099 DIV, it shows that there are qualified dividends of $200, and you have to remember that the $200 is included in the $300. So when we look at pure investment income, although we think of the amount showing in Box 1 of ordinary dividends as investment income, we would have to subtract out the amount in Box 1B. So ultimately, his pure investment income is only $200. He then has $200 of qualified dividends and $300 of capital gain distributions, which means he has $500 of capital gain income. So when we look at his overall investment income, we have $200 that is pure investment income, $500 which is capital gain income, for total investment and capital gain income of $700. Now during the year, Austin paid $800 of margin interest through his investment brokerage account, and he also has investment interest expense carryover from 2011 of $100. So let's prepare his 4952 for him. We begin on line 1 by entering the investment interest expense that he has for 2012, and that's $800. I told you he has a $100 carry forward from 2011, so we add that in on line 2, and on line 3 we enter the total $900. Then on line 4 it asks for the total gross income that he has from investment purposes, and that's the amount showing up here on his 1099 DIV and his 1099 INT. His 1099 DIV is for $300 in Box 1, and his 1099 INT is for $100. If you add those up, you get $400, and that's the amount that we're going to enter here on line 4A. But then it says, of the amount on line 4A, how much of that was qualified dividends? Qualified dividends was $200, and that gets pulled out of the $400, leaving only $200 carrying over to line 4C. So as we sit here right now, Austin Powers has only $200 of investment income, which could limit his investment interest deduction to only $200 for the year. But he has that capital gain income as well, that capital gain distribution of $300. He also has an ability on line 4G to enter the amounts that show on line 4B and line 4E that he wishes to treat as if they were investment income. And he's going to make an election to treat both of those income amounts as investment income in full, and so he enters $500 on line 4G. He then adds the $500 to the $200, and he comes up with $700. So even though his investment income was only $200, he can elect to increase it to as high as $700, and that will allow him to offset $700 of the $900 of investment interest expense that he has. So he will be allowed a $700 deduction that he will enter on line 14 of Schedule A, and he has a $200 carry forward that will go to his 2013 return. So here is a summary of all of the different types of interest that you might have and where you claim them. We begin with student loan interest. If you are able to deduct student loan interest, you do so on the front of your Form 1040 on line 33. If you have home mortgage interest and points that are reported on a 1098, those go on Schedule A, line 10. Home mortgage interest not reported on Form 1098, that goes on Schedule A, line 11. Points not reported on a 1098, that goes on line 12 of Schedule A. Mortgage insurance premiums are reported on line 13 of Schedule A, and investment interest expense that is incurred but not to produce rents or royalties goes on line 14. Business interest, non-farm interest, is claimed on Schedule C. Farm interest is included on Schedule F. Interest incurred to produce rents or royalties is claimed on Schedule E, and personal interest is, well, just not deductible. Sting, S-T-I-N-G, sting. So let's take a look at the next topic and the final topic of the day, which is charitable contributions. Those are entered on lines 16 and 17, and also 18 if you have a carry forward. And of course, in order to make a deduction on Schedule A, you have to have made your contribution to a qualifying organization, so that's where we're going to start. You can deduct your contributions to charity only if you make them to a qualified organization, and to become qualified, an organization must generally apply for nonprofit status with the IRS. And we're hearing a lot about this on the news lately, aren't we? Everyone in the IRS is in a turmoil, and in our federal government is in turmoil over the fact that certain organizations who had the word Tea Party in their name, I think it was Tea Party in their name, were being given a very close look over by the IRS in terms of whether or not they would be given the nonprofit status. And some people feel that the law has been violated there, and so there's a whole lot of hoopla over that. And ultimately, it's because people want to be able to make contributions to those organizations and take write-offs for them on their tax return. And if those organizations don't hold that status with the IRS, then the write-off is not allowed. And if the write-off is not allowed, then maybe people won't want to contribute as much. So it's this whole cycle going on. So if you are concerned about whether or not an organization qualifies with the IRS and has that status, you can actually go to the IRS website and figure that out. Now, one of the things you can also do is just ask the organization, hey, organization, are you a qualified nonprofit organization? And typically, if they are, they will say that they're a 501c3 organization. But interestingly, churches and government organizations do not need to have 501c3 status. So if you make a charitable contribution to your state, maybe the school board for your state, I don't know who would do that because most people donate to PTAs, but let's just hypothetically say that you make a donation to your state. You don't have to find out if the state's a 501c3. They don't need to be because they're a government. The other side is churches. Interestingly enough, the IRS says churches don't have to have that 501c3 status, and it's typically safe to donate to a church. But if you're not donating to either of those entities or types of entities, then you would need to determine whether or not the organization is registered with the IRS as a nonprofit organization. And most organizations that are registered with the IRS know whether or not they are, because it's no easy matter. It takes a lot of paperwork, a lot of money to get registered with the IRS, and they do have to file annual returns each year to maintain that status. So if they haven't done those things, then they're probably not. Many years ago, this is kind of funny, I had a group come to me because they had discovered that their nonprofit tax returns had not been filed for several years, and they came to me to get those done. And so I said, okay, well, where's the last tax return that was ever filed for you? And no one knew who that was because, the people involved in this organization, they turned over. They were typically involved at the college level, and as people moved out of college, new people would replace them in this organization, and no one really knew anything of what was going on. So I said, okay, well, let's just see if you're even registered as a nonprofit at all. And they weren't. There was an international body that was a recognized 501c3, but they were a subchapter of it, and they were not the registered body. They were basically an affiliation of that, and they didn't have it. There were plenty of other subchapters that were registered, but not theirs. And so then the question was, did they want to go through the time and expense necessary to become registered as 501c3? And the answer was no, they didn't, and so they just said, that they weren't that. But if you aren't registered as a 501c3, then it means the organization itself should be filing a tax return, either a partnership return or a corporation return. It just depends on how they formed the entity and where their money's coming from. So it's not that they don't have to file, it's just that they file a different form. And on top of that, any contributions made by members to the organization are not deductible. So for us, from filling out a Schedule A, our client has made a contribution to a charitable organization. Can they deduct it? They can if it's a registered organization with the IRS, or if it's a church or government body. Contributions from which you benefit. You cannot claim a deduction for a contribution you make to an organization to the extent that you benefit from that contribution. Cash contributions. You cannot deduct a cash contribution regardless of the amount unless you have a record such as a canceled check or a bank statement showing the name of the charity, the amount, the date, or a written communication from the charity. Now, if at the time you're making a cash contribution to the charity, you happen to get a gift from that charity as a thank you, your deduction is going to be limited to the difference between your contribution and the value of that gift. And OPB, here it's the Oregon Public Broadcasting, which is the PBS nationwide entity, is clearly a 501c3 type organization. Contributions to it are definitely deductible, and each year or each month, whenever the pledge drives are going on, they're usually tantalizing you with a free CD or a free DVD. If you donate $110, you'll get this DVD of the artist. And so they're, enticing you to donate maybe a little bit more than the minimum amount, which for OPB in our area, an annual membership is $35. So if you donate $90, you'll get the free membership and you'll also get this DVD. And let's just suppose that the DVD is worth $15 and you donate the $90, so you get that $15 gift. Well, ultimately, that's going to reduce your allowable deduction down to $75. You wouldn't be allowed to claim the full $90. And they have another example here. You purchased 2 tickets at a charity auction. The tickets are valued at $100 and you pay $150. That means your deduction will be $50. Another place that I see this happen all the time locally in our area is the school auctions. School foundations hold charity auctions every year throughout the city to raise money to help provide extra money for the school curriculum, for supplies for teachers, and even to actually fund additional teachers for that school. And at the charity auction, if you're purchasing items for sale there, odds are that you're not going to be allowed to deduct that, because very often what you pay for or what you bid for that item at the auction is less than its value. But there are certain items that definitely go on the bidding block that sell for far more than they're worth. For example, at the charity auction that I attend each year for my son's school, there's a very popular former principal of the school. The school body just loves him, and every year up on the auction block goes a fishing trip with Ben. And so the parents get up there and they madly start bidding to take this fishing trip with Ben, which is probably overnight in a log cabin. I bet you the whole value of the entire trip might be, you could coax out of it $300. But they're going to bid rapidly on that. They're going to be trying to bid who's going to get to go on that fishing trip with Ben, and I've seen bids come in $1,500, $2,000. So now you're going to have to do some careful math there. What is the true fair market value? Well, you could say the amount that someone would be willing to pay between a willing buyer and a willing seller, but at this auction things get a little frenzied and probably sell for more than they're worth, and that's where you'd have to be doing that computation. The charity auctions are kind of tough. It's hard to put a real value on what something is worth compared to what it sells for. I still try to do the best I can. But for sure, when you're at one of those charity auctions and they go up for the paddle bid, and that's just you bid a flat amount. You might bid anywhere from $10 to $500 to $1,000, and the parents or the people participating in that auction are making those bids. Those cash paddle bids are definitely deductible in full. There's another one. The private parking space at the school. I don't know if you've seen those. If your school holds an auction and you drive up in the parking lot and some parent paid $3,000 to get their own parking spot in that parking lot for the year. I don't know, the spot next to it is free. So I don't know how much of a value you'd put on the one that they paid for. I suppose it would depend on how tight parking is there. You could do the best job you can. Now let's look at some other amounts that people might pay during the year that could be deductible. Membership fees or dues paid to qualified organizations. You can deduct the cost of membership fees that are $75 or less, and you can deduct a larger amount only to the extent that you do not receive additional benefits solely because of the higher dues. If you pay an extra amount and receive extra benefits, you must subtract the value of those benefits from your charitable deduction. And you can still pay $75 or more than $75 and get a deduction of more than $75 as long as you do not receive additional benefits that are not available at that lower membership cost. And I've got some examples here. And this is what always gets my clients and many tax preparers as well. In your area, you probably have a zoo. You probably also have a science museum. You probably also have a children's museum. There's probably an arts museum, museum of fine art. And they all have annual memberships ranging, at least in our area, anywhere from a low of $35 up to a high typically of around $74. But you can pay more than that. And the reason those charities pick those membership due levels is because any amount that they pay at $75 or less for a membership is automatically deductible by the person who becomes the member. And it is the case that they sell higher level memberships as well, so I'm going to go through some illustrations here. You obtain a family membership at the zoo for $74 per year. Even though you are entitled to free admission to the zoo with your membership because the cost of membership is $75 or less, you can claim a deduction for that membership fee. Under example number 2, the membership fee is greater than $75, but it's still deductible. You obtain a $500 zoo membership as a special sponsor. You gain additional privileges of nominal value, like they put you in their publication and list you amongst 500 other people as being a special sponsor. You can still claim the $500 as a deduction for charity because you've gained nothing other than the appreciation of the zoo. Now, a written statement is required if payments for benefits are greater than $75, and generally the charitable organization you donate to is required to give you a written receipt that breaks down the amount of your contribution from the value of the benefits you receive. There are certain exceptions that do apply to that. You should see written statement in publication 17 for more information. The next type of cash contribution we're going to be moving on to is volunteer expenses. Very often I'm confused, or historically I was confused, is a volunteer expense cash or non-cash contribution? Just to clarify it is cash. If you do volunteer work for a charitable organization and you incur expenses in your work for that volunteer work, those are treated as a cash expense and a cash deduction for you. You can deduct expenses you paid to provide volunteer services to a qualified organization. To qualify, the expenses you pay must be unreimbursed, directly connected with the services, expenses you had only because of the services, and not personal or family expenses. Conventions. If you are a chosen representative of the qualified organization, you may deduct your travel and meal expenses directly relating to your official duties for the organization. You may not deduct the cost of personal activities or the cost of bringing your family members with you. Uniforms. The cost of uniforms you must wear while performing donated services and which are unsuitable for personal use may be deducted. Examples of deductible uniforms include choir robes and volunteer firefighting gear. If you care for a child placed with you by a qualified organization, you may be able to deduct the expenses for the care of that foster child that are unreimbursed out-of-pocket expenses to feed, clothe, and care for the foster child and are mainly to benefit the qualified organization. Expenses you incur caring for a foster child that you intend to adopt are not deductible as a charitable expense. Well, this foster parent thing, when I first got into taxes many, many years ago, I was asked to go and speak before a group of foster parents to explain to them what they can deduct. And ultimately, most of the time when a foster child is placed with you by the state's paying you money to care for that foster child. And the parents that I talk to who have foster children placed with them are usually receiving, at least in our area, $1,500 a month per child. It's going to take a lot of work to show that they paid more than $1,500 a month to support a child. But if they can do that, if they can show that they paid more than $1,500 a month to support that child, then IRS is saying they can claim that deduction. But you do have to figure into that most of the time when people do become foster parents, there is a money incentive given to them for that. Transportation. You can deduct auto expenses you incur while providing volunteer services to a qualified organization. You must keep written records to prove the expenses. Allowable auto expenses can include the actual cost of gas and oil, but not repairs, or a standard mileage rate of 15 cents per mile, and you can also deduct the cost of parking and tolls. You cannot deduct the cost of driving to church unless you go to church on official business as a volunteer. Travel. You may be able to deduct travel expenses you incur while providing volunteer services to a qualified organization subject to the following conditions. You must be performing services for the qualified organization. There can be no significant element of personal pleasure. The trip must be substantially for duties you are performing for the organization. If you have only nominal duties, or if significant portions of your time are not spent performing your duties, you cannot claim your travel expense as a charitable deduction. For exchange students, you can deduct expenses you paid for students living with you under a written agreement with a qualified organization subject to the following limits and conditions. And they're pretty arduous. You may be able to claim a deduction of up to $50 per month per student enrolled in 12th grade or lower. The student cannot be related to you. The student cannot be your dependent. The student must be attending school full-time at least 15 days during the month claimed, and you cannot deduct costs of a foreign student living in your home under a mutual exchange agreement in which your child goes to live with the foreign family. Non-cash contributions. These are claimed on Schedule A, line 17, and at least with my client base, a good portion of what my clients are donating is non-cash. I don't have huge cash contributions outside of church. It's just my experience with my clients. I think in higher income situations, CPA firms who are dealing with fairly wealthy clients might find that they're giving large amounts of cash out to various foundations and charities that they participate with. But your everyday middle-class taxpayer or lower income taxpayer, their contributions are going to be pretty limited. Typically, I see tithing going on to church, and I see non-cash contributions being given to Goodwill and Salvation Army. So for a good part of the population out there, non-cash is a really big portion of what is donated, and there are some specific rules that have to be applied. I do see a question come up here. Leslie asks, if you were to participate in a breast cancer 3-day walk that wasn't in your state, what, if any, would be considered deductible? Well, if you are doing an official duty for that organization, that the organization recognizes you and appoints you to that, then I would say yes. But if there's just a charity march that you decide to drive out there and participate in it, that is more questionable. You would need to have a letter from that organization saying that you were doing it as an official representative of the organization, you had official duties for that organization, and they were unreimbursed. Those are the conditions that IRS spells out in its publication. And back to non-cash contributions. If you have a non-cash contribution and it is deductible, you enter it on Schedule A, line 17. To figure how much you are allowed to deduct for the property that you contribute, you must first determine its fair market value on the date of the contribution. You generally can claim a deduction for the lesser of the fair market value of an item that you donate or your cost basis in the item. So how do you determine the fair market value? Well, fair market value is the price that the property would sell for on the open market. It is the price that would be agreed on between a willing buyer and a willing seller, with neither being required to act or being forced to sell or buy, and both having reasonable knowledge and relevant facts. In making and supporting the valuation of property, all factors affecting value are relevant and must be considered. These include the cost or selling price of the item, the sale of comparable properties, replacement costs, and opinions of experts. The valuation of restricted use property. The IRS in Publication 561 states that if you put a restriction on the use of property you donate, the fair market value must reflect that restriction. And here is an example. Restricted use property. If you donate land and restrict its use to agricultural purposes, you must value the land for charity purposes at the value for agricultural purposes, even though it might have a higher fair market value if it were not restricted. So let's just suppose you have land, it's farmland, and you donate it to a charity and say, this land can be used by your charitable organization, but only for farming. Even though at that point in time you could sell the land and have it converted to residential use where it would be worth a lot more money. Well, if that is what you chose to do, you could claim a donation, but only for the fair market value of what that land is worth as farmland and not as residential land. Used clothing and household goods. Generally, the fair market value of these items is much less than you paid for them. As a guideline for evaluating these items, the IRS has Publication 561, or you can visit a local resale store. The amounts these items sell for at Goodwill or Salvation Army is also an acceptable form of valuation. Now, even though the fair market value of property is generally much less than you paid for it, it's often higher than you might think. And I see people all over the board on this. I'll have one client come to me and they'll try and take a charitable donation for $30 on a dress that they paid $30 for. And I'll say, well, no, you're not going to be allowed $30. You're going to be allowed what it's worth. It might be worth $8, which is a fraction of what you paid for it. However, $8 might be much more money than another person might think that dress is worth. I've got people who come in and they might have paid $200 for a nice dress, and they think it's worth $3 or $4. They don't think it's worth anything because it's used. And in their mind it isn't, because they would never buy a used dress. But if that dress is donated to Goodwill or Salvation Army and they put it on the shelf for sale, on the rack for sale, how much are they going to sell it for? Because that's what the IRS says you can claim a deduction for. And furthermore, it could be that that dress is even worth far more than that, because it's a designer type item, and if it went into a resale store, maybe it would sell for significantly more. I don't shop resale stores much, but my sister-in-law loves them, and there's a high-end one in Walnut Creek, California. There's a shopping area there. It's a ritzy-ditzy area, and she likes to take me there. And in this area, there is a store, a boutique, and the only thing they sell is used designer stuff. And oh my gosh, is that stuff expensive. It's like I wouldn't pay that much for it when it's new, and I wouldn't pay that much for it used either. But apparently people are willing to pay that, and so that store does exist. So you do have to take into account all of the different methods for valuing property, and resale store could be a place that you could use as a guideline for valuation. But Salvation Army, Goodwill, these are the easiest ones to use as valuation guides. If you give used clothing to the Salvation Army or Goodwill or other items from around the house, the fair market value could be the price that buyers actually typically pay for clothing at this age, condition, style, and use in those stores. And usually they are worth less, far less than was paid for them, but sometimes more than you might think they're worth. Now, inside the manual here, I've inserted links to the Salvation Army's valuation guide, and I've also inserted another link to the Goodwill's valuation guide. And the Salvation Army one I liked better. It's much more extensive, and so I actually copied that and pasted it in the manual for you here. And this can be a real handy reference just to keep around for when your clients come in. They've come in, they've brought in a list of all of the items they donated, but they don't know what they're worth. And so you can go through this with them and looking at the condition of the appliance, the age of the appliance, establish a low or a high value for it. And you can see here a washing machine has a low value of $400 and a high value of $150. Well, I can remember in the not too distant past, I was tight on money, and when I needed a washing machine, I didn't go look at new ones that cost $400. I went to the used appliance store and paid $100 for them. So I can see where washing machine, $150, that seems like a pretty realistic amount to pay for a washing machine in good working order, and a relatively newer model one. Going into children's clothing, I can remember when I had my first baby, one day I ended up in a children's store, and I didn't realize it was a resale store until I'd been in there for, actually till I got home. I was in there, and every garment I picked up off the shelf in that store was so cheap. It was like $3, $10. I had a party, and I bought all these used clothes for my baby and got home. And the next time I was driving by that store, I realized, oh, that was a resale store. And then I thought, that was expensive. I paid that much for something that was used. So yeah, it's all perspective on what things you think they might be worth. And if you look here at what kitty items are worth, you've got a pair of kids' pants. The low is $250, the high is $12. That's a lot of money to pay for a used pair of kids' pants, I think. But when you're looking at deductions, I would be asking my client, where do they shop? And how much did they originally pay for that garment new? How old was it? What kind of condition was it in? And then use those mechanisms to figure out a value. You go through here, we've got furniture. Furniture is something that seems to hold its value pretty well. I mean, if you were to look for a used sofa, you don't want to go to the store and buy a new sofa because it's just too expensive, but you need a new sofa for your house. So you start going to the resale furniture stores, or you start shopping on Craigslist for a used sofa. They're expensive. And even when you get into the Salvation Army, they're still expensive. Salvation Army is saying a bedroom set could be worth a low of $250 and a high of $1,000. That's a pretty broad range. And so if your client did give away furniture, it would be worth it to get out this guide and go through it to come up with a good valuation. All right, let's move on and talk about cars, boats, and aircraft. If you donate a vehicle, including a boat or aircraft, to a qualified organization after December 31, 2005, your deduction is limited to the gross proceeds from its sale by the organization. This rule applies if the claimed value of the donated vehicle is more than $500. So if you donated a vehicle to the organization and you've got a receipt for the donation of that vehicle, you can pretty much claim $500. But if you want to go over $500, then you're going to have to get a document from the organization that shows what that vehicle sold for at auction. And that document is called a 1098-C. Now, the only time you don't have to follow that rule and get a 1098-C is if the charitable organization, instead of selling the vehicle at auction, makes significant intervening use of the vehicle, materially improves the vehicle, or transfers the vehicle to a needy individual in direct furtherance of the donee's charitable purpose of relieving the poor and distressed or underprivileged who are in need of a means of transportation. Most of the charities out there that accept vehicles accept them and sell them at auction. And so most of the time, if your client is trying to claim a write-off for a vehicle that they donated, you're going to be asking for the 1098-C. IRS says you cannot claim more than $500 without the 1098-C, and if they did get a 1098-C, you have to attach it to the return. Giving property that has decreased in value. You can claim a deduction for an item's fair market value only, even if it is less than you paid. For clothing and household items, you cannot take a deduction for clothing or a household item you donate unless that item is in good, used condition or better. I always laugh at that because once the item is donated, how would the IRS know if it was good, used condition or better? Let's argue that the IRS might dispute that. Well, what I do is I take a picture of the items that I'm donating. I recommend the same to my clients. And so every year, probably 3-4 times a year, I'm giving away stuff to Salvation Army, Goodwill, the Vietnam Vets Organization. So I'll lay out on the bedroom floor or out on the floor of the garage all of the items I'm donating, and I'll take pictures of them. And I'll make a list of everything I donated. And when that charitable organization does the pickup and they give me the receipt, I attach those documentation together, and when it's time to prepare my return, then I start figuring the values that I'm going to be allowed to deduct. So the IRS typically wants to know what you paid for an item. They want to know the fair market value of that item on the date of the donation. They want a receipt from that organization verifying that the donation was made. And then finally, how do you even establish a valuation on that item? Well, a picture might be a good way to do that. So that's why I take pictures. It's not anywhere in the IRS instructions, but I figure it can't help. Or maybe it is in the IRS instructions and I still do it anyway. So household items that must be in good condition or better include furniture, furnishings, electronics, appliances, linens, and other similar items. If your client tells you that they donated a television, but it was old and didn't work very good, they're not going to be allowed a deduction. If they tell you that they donated a television that was in good working order, then you would go over to the Salvation Army valuation guide and just see what a television is worth and find it in here. If you've got a DVD player that's up maximum of $15, that probably seems accurate. Televisions are in here somewhere. You can look for it yourself. But at any rate, they had a pretty good value on televisions, I thought. More than I would be willing to pay for a typical used television. Household items not to include in the valuation system there, or that they have to be in good used condition or better, is food. Paintings, antiques, and other objects of art do not need to be in good used condition or better. They can still have value. Jewelry and gems and collections. So if you give away a stamp collection or a comic book collection, those would be examples of items that might actually be in pretty poor condition but still have a very high value. And so for those items, they don't have to show that they're in good use condition or better. Now, an appraisal is required for certain items that are more than $500. You can take a deduction for a contribution of an item of clothing or a household item that is not in good use condition or better if you deduct more than $500 for it and include a qualified appraisal of it with your return. So you don't always have to have a qualified appraisal, but if the item is not in good use condition or better, then you probably should have an appraisal before you try and claim that deduction. For donations of inventory, these rules that I just described do not apply to donations of inventory. For example, these rules do not apply if you are a car dealer who donates a car that you had been holding for sale to customers. And frankly, if you are a car dealer, that would, in my mind, be a cost of goods sold item and not go on Schedule A at all anyway. Form 8283, if your total non-cash deductions exceed $500, then you must maintain a record required for donations of $250 or more. You must complete and file Form 8283 with your federal return. And on Form 8283, you must provide the name and address of the charitable organization and a written description of the items that you donated that includes their cost to you, their fair market value on the date you donated them. Note that this rule applies whenever the total of the contributions exceeds $500, not just when a single item exceeds $500. So here's an example of what I mean. You donated used furniture to Habitat for Humanity, and the fair market value of the furniture is $450. 2 months later, you donate books with a fair market value of $50 to the county library, and then $200 of used clothing to Goodwill. Even though none of those contributions was $500 or more, when you add them up, you have more than $500, and as such, Form 8283 would be required. So you should never see a situation where you've entered $700 as a deduction on the non-cash line of Schedule A without also having 8283 attached. And underneath I do have an illustration of 8283. It's for different numbers. It's not the same illustration. So don't be confused about why the numbers look different, because it's not an attempt to make them the same. So here we have 3 different charitable organizations. We have the date of each donation. We have how the items were acquired by the donor's cost, the fair market value of those items, and what method you used or the donor used to arrive at a fair value. Thrift store or comparable sale is typically what I choose to list. Now, giving property that has increased in value, this is probably one of the more confusing aspects for tax preparers who work for me and tax school students who I teach, getting the rules around property that has increased in value. Giving property that has increased in value. If you donate property that has increased in value, you need to consider the type of property you donated and whether you held the property short-term or long-term before you can determine the amount that you can deduct. Short-term ownership is ownership of 1 year or less. Long-term ownership is ownership of more than 1 year. Ordinary income property. You can deduct your basis or cost in the property only. Ordinary income property is property that, if sold, would be treated as ordinary income or as short-term capital gain income. Examples include cost of inventory or business goods that you donate, cost of artwork or manuscripts that you created, and capital assets such as stock or investment property which you owned 1 year or less. Capital gain property. Generally, if you donate stock or investment property held for more than 1 year, you can claim the fair market value of that property as a donation, even if it's more than you paid for it. So here is a summary of the 8283 rules, and then we're going to go in and look at a more complex illustration of an 8283 and do some group exercises together. All non-cash contributions must be reported on Form 8283 if the total of all of the non-cash contributions exceeds $500. You must provide the following information for each organization to whom you made a non-cash contribution: the name of the organization, a description of the property donated, the date that the items were donated, the date the items were acquired, the method used to determine the fair market value of the donated property. Certain donations of household items valued at more than $500 require a written appraisal. For certain donations of items valued at more than $5,000, a qualified appraiser must provide a written appraisal, and the appraiser must sign Part 3 of Form 8283, which is page 2 of the form, and the donee organization who receives the gifts must sign Part 4 of Form 8283. You must attach a copy of the appraisal to your return if you donated art valued at more than $20,000, an easement for the exterior of a building in a historic district, or you claimed a deduction of $500 or more. And in certain situations, you also have to attach it when you donate property that is not in good use condition or better, and you're claiming a deduction of $500 or more. Limit on carry forward of the deduction, Schedule A, line 18. There is no limit on the amount of deduction that you can claim if your total cash or non-cash contributions are 20% or less of your adjusted gross income. However, if your contributions total more than 20%, certain restrictions apply. Your deduction can never exceed 50% of your adjusted gross income. Your deduction is limited to 50% of your adjusted gross income if you make your cash or non-cash contributions to a 50% limit organization. And most organizations are 50% limit organizations. But even if you contribute to a 50% limit organization, your deduction will be limited to 30% of your adjusted gross income if you contributed capital gain property. There is an exception to this if you choose to claim a deduction for your adjusted basis rather than the appreciated value of the property. There's a 30% limit. Your deduction for cash or non-cash contributions cannot exceed 30% of your AGI if you gave to a qualified organization that is not a 50% organization. And examples of non-50% organizations include veterans organizations, fraternal societies, nonprofit cemeteries. These are all examples of 30% organizations. But also, if you gave appreciated capital gain property to a 50% organization, then your deduction is limited to 30%. And finally, we have a 20% limit. This limit applies to all capital gain contributions given to a non-50% limit organization. So let's summarize these rules in this table. If the property you donated is cash or non-cash, The deduction is limited to 50% if it's made to a 50% limit organization, and it's 30% if it's made to a 30% limit organization. If you donate capital gain property, the deduction is limited to 30% if it's made to a 50% organization, and it's limited to 20% if it's made to a 20% limit organization. So what does that mean? It means that if you donate an item to charity, and it's a capital gain item, just for an example, and the value of that item that you wish to deduct is more than 30% of your income, then you're going to have a carry forward. You would figure your adjusted gross income, multiply your AGI by the percentage limit, let's say 30%, and whatever that amount is, you're allowed to deduct that amount. And anything above and beyond that would carry forward to the next year, and it would be entered on next year's Schedule A, line 13. You can carry your deduction forward for up to 5 years. To help explain how this works, I've created a group exercise, and I have the answer key for this exercise. It's located in the manual. For each of the following taxpayers, determine the limit on the deduction that each can claim for the contributions to the charities described. Todd donated $50,000 cash to help construct a new elephant exhibit at his local zoo, which is a registered nonprofit organization. His AGI is $80,000. How much can Todd deduct? Well, firstly, we look at the $50,000 cash to the organization. What is his AGI? His AGI is $80,000. This is a 50% limit organization. So how much is his deduction going to be limited to? The answer is yes, $40,000. So 50% of $80,000 is $40,000. He's allowed to donate $50,000. He will deduct $40,000, and he will carry forward $10,000 to 2013. So let's move on to the next one. And in the next problem, I'll perk this one up here. Problem number 2, we have Richard. He donated property with an appraised fair market value of $35,000 to his college alumni, which is a 501c8 organization. His AGI is $100,000. What amount can Richard deduct? It's capital gain property. So how much can he deduct? Well, the answer is that he's going to be limited to 20% of his adjusted gross income. He's donated capital gain property to a 30% organization. A fraternity is an example of a 30% organization. And if you donate capital gain property to a 30% organization, your deduction is limited to 20% of your AGI. Now, if he just donated property on which he was claiming his cost and not an increased capital gain value, then he would be able to deduct the $35,000. But if it's capital gain property and he wants to claim a deduction for the increased value, then he's limited to 20%. This last one is probably the trickiest. Jennifer's AGI is $150,000, and during the year she donated land with a fair market value of $80,000, according to a qualified appraisal, to her church. Jennifer received the land as an inheritance in 1992 when the land had a fair market value of $30,000. Jennifer also donated $2,000 in cash to her daughter's school foundation, which is a qualified charitable organization. What amount can she deduct? Okay, that one is a bit of a head scratcher. I bet you some of you were looking for $45,000, weren't you, and wondering where's the $45,000? Well, the 47's close. I'll pick that. I think a lot of you went for that, and some of you may understand that 47 actually is the correct answer. And to show you why, I'm going to take you to the answer key for this problem at the back of the manual. This is it right here. So the group exercise answer key, I've got descriptive answers of each question, and the final one, Jennifer here, is the most detailed. So we have to look at the following rules. Firstly, Jennifer's church is a 50% organization to which she donated capital gain property. Therefore, her deduction for her capital gain property is going to be limited to 30% of her AGI. If her AGI is $150,000, 35% of that is $45,000. But on top of that, she made a $2,000 donation to her school's foundation. And that amount is being donated to a 50% organization as well. It's a cash donation. So she's not going to be limited by the 30% of her income rule. She's going to be limited by the 50% of her income rule, and that's well less than that, isn't it? So she's going to be allowed both those amounts. She's going to be allowed $45,000 up here plus $2,000 down here, and that's where the $47,000 comes from. The IRS has a very lengthy worksheet that you can fill out to arrive at your net deduction for charity. And up here on line 3, it asks the cash contributions. On line 4, it asks for the non-cash contributions. On line 9, it asks for the adjusted gross income. And on line 10, you enter 50% of the AGI. Then it asks you on line 19 to enter 30% of AGI. And then we subtract the $45,000 from the amount, or the gift, the $80,000 gift given, and we're left with $35,000. And ultimately, the deduction is going to be this $35,000 that carries to here, plus the $2,000 up here. And ultimately, the instructions say enter $47,000 on Schedule A, line 19. That's the allowed deduction. And I believe I did carry that over and show you Jennifer's Schedule A right here. So on the Schedule A on line 16, we enter the $2,000 of cash contribution on line 16. On line 17, we enter the full amount of the non-cash gift, $80,000. But on line 19, that's the line that's limited to $47,000. And we did the worksheet to figure that out, or we used our brain power to figure that out. And because she made a gift of over $5,000, Jennifer needs to fill out page 2 of her 8283. So I thought I would show you that as well. And on page 2, we have to check that what she donated was real estate. We're providing a description with the address of the property, the appraised value of the property, how she acquired the property, and her cost basis in that property. Now you will see that space is provided for the declaration of the appraiser. She would need to get this property appraised and get the appraiser to sign it. And then in addition, she would need to get the church that received the donation to sign it as well. So the final discussion points for you are for where to deduct your contribution, which we've really already covered, and some of the limits on non-cash contributions, and also record keeping. Record keeping is really important. And if your client doesn't have adequate records to prove their donation, they can get in trouble. And so beginning on page 69, I have some information about records to keep. The IRS has a rule that says if you make a cash contribution to a charity, even if it's only $1, you have to have proof of that donation. It has to be in the form of a canceled check, a bank or credit union statement, a credit card statement, or a receipt from the organization. Bank and credit card statements should show the name of the charity and the date and the amount paid. Credit card statements should show the name of the charity and the transaction posting date. Donations of money, including cash, check, electronic funds transfer, credit card, or payroll deduction. For payroll deductions, the taxpayer should retain a pay stub, the Form W-2 wage statement, or other document furnished by the employer showing the total amount that was withheld for the charity. If you make a cash contribution to charity, in addition to being able to prove how you made that payment, you have to have a written confirmation from the charity. You must obtain that written confirmation by the time you file your timely return or by the due date, including extensions for the return. And most people who are giving money to their church, a lot of times I find my clients are not very good at the record keeping side of that. They should be making checks to the church and putting those in the basket. Or they should be putting their money, their cash money, into an envelope with their name on it so the church can record it. They need to have some kind of verification system going on to prove that they made donations. And if they can't prove those donations, they're not going to be allowed to deduct them. So that's an important detail. For non-cash, the IRS says you must keep a written record of each item you donate, and the written record should show a description of the property given, the date of the contribution, the fair market value of the property given, the cost basis of the property given, the amount of the deduction you are claiming on your return, and you must keep a receipt from the organization that shows the name of the organization, the date of the contribution, and a description of the property given. You are not required to obtain a receipt where it is impractical to get one, but you must still keep a written record, a note or journal of the description. For example, at Goodwill's unattended drop sites, you wouldn't be able to get a receipt. And that's okay as long as you keep a written record of the donation. But if the amount was over $250, you have to have the receipt, and you wouldn't be allowed the donation to be more than that otherwise. For non-cash contributions of $250 or more, you must maintain all of the records just mentioned up here, 1 through 6, plus You must obtain a written acknowledgement that includes a description of the items given and a value of any benefits received in exchange for that donation. The written acknowledgement must be obtained by the earlier of the date you file your return or the due date for your return, including extensions. Total non-cash contributions are more than $500. If your total non-cash contributions for the year are more than $500, you must maintain all records for donations of $250 or more, and you must complete and file Form 8283 with your return. There's more information here on what to do when it's over $5,000 and certain art, but I'll leave you to read those on your own. There's also information here about who is a qualified appraiser. It's important as well. And then non-deductible contributions, we'll just finish up our class today with a real quick review of what's non-deductible. You cannot claim a contribution to an individual. If you give money to the old beggar on the street, it's not deductible. Contributions to non-qualified organizations, including homeowners associations, labor unions, and of course political candidates, are not deductible. Contributions from which you benefit. You cannot claim a deduction for contributions you make to a qualified organization to the extent you receive benefits in return. Your time has no value at all when it comes to a charitable contribution. No deduction is allowed for your time, and that's logically because you don't include the value of your time in your income. Cost of meals, unless you are there on official duties for your organization, meals are not allowed. And adoption expenses, those costs are also not allowed. And then moving on to the next assignment in the classwork, which is for Angela Biggins. And the question with regards to Angela Biggins is this. She is single. She has $30,000 of adjusted gross income. She has $5,000 of mortgage interest, $1,000 of property taxes, and she had $3,000 of state withholding on her W-2. During the year, she gave the following items to charity: a 1991 Civic, purchased in 1998, sold for $1,000. It cost her $2,000. She gave $500 to the church, and she had volunteer search and rescue costs. She drove 1,000 miles for volunteer search and rescue, and she paid $1,000 for the cost of caring for those search and rescue dogs. Go ahead and prepare her Schedule A. And I did want to show you what a 1098-C looks like. This is it. And anytime you claim contribution for more than $500 for the donation of a vehicle, you should be looking for this 1098-C to come in. And all of the information on this 1098-C needs to be transmitted to the IRS.
Please pause the lecture video and complete this session's classwork. Enter your answers into the LMS when you have finished. Then resume the lecture for the classwork review.
So let's open up her answer key. So we enter the deductions on the appropriate lines of the Schedule A. We enter the income tax of $3,000, the property tax of $1,000, the mortgage interest of $5,000. We enter the gifts to charity of $1,640, but we also, on line 17, are claiming the non-cash contribution of that vehicle. It's more than $500, so the 8283 has to be attached. And here is the 8283. On here, we indicate that the donation went to the March of Dimes. We show the description of the vehicle. If the donated property is a vehicle, check the box and provide the VIN, the vehicle identification number, which we've done. And we've entered the date bought, the date donated, how it was acquired, which was by purchase, the cost, the fair market value, and valuation method we used, and that was auction value. So that concludes the review of the cluster key and the conclusion of today's class. Thank you for participating. We hope to see you again soon. Bye-bye.
To complete this session, number 1, take the password test in the LMS. Number 2, complete the homework assignment and enter your answers into the LMS. And 3, complete the quiz and enter your answers into the LMS.
Dolphin, D-O-L-P-H-I-N, Dolphin.